So these are the 1 markers and the 2 markers from the retirement and the dissolution of a partner. So what do you mean by retirement? A partner is said to be retired when his relationship with the firm as a partner comes to an end. Gain ratio, the formula is new ratio minus old ratio. Why is the gain ratio required on retirement of a partner? It is required for the purpose of writing off the goodwill created to the extent of retiring partner's share. Why is the new ratio required on retirement? To share future profits. Calculation of new profit sharing ratio. New share is equal to old share plus share gain. Hidden goodwill is the amount paid in excess due to retiring partner. Next is the 2 markers mentioned in 2 circumstances for retirement: old age and misunderstanding. Gain ratio is the ratio in which the remaining partners acquire the share of the retiring partner on his retirement. Sacrifice ratio and gain ratio, the difference. Sacrifice ratio is calculated at the time of admission, gain ratio at the time of retirement. Share sacrifice is equal to old share minus new share, and share gained is equal to new share minus old share. 2 purposes for calculating NPSR: to write off goodwill and to share future profits. 2 methods of treatment of goodwill: created at full value and retained in the books, created in full value and written off immediately. How do you close revaluation account? By transferring profit or loss on revaluation to all partners' capital account. Journal entry for adjusting the retiring partner's share of goodwill when goodwill is raised. Gain ratio account, that is gain ratio, remaining partner's capital account debit to retiring partner's capital account. Of payment on settlement of retiring partner's capital account through bank overdraft or in lump sum. Journal entry to close the retiring partner's capital account when the payment is made immediately. Retiring partner's capital account debit to cash or bank account. Journal entry to close revaluation account when there's profit. Revaluation account debit to all partners' capital account. Entry to close revaluation account when there's loss. All partners' capital account debit to revaluation account. Why do firms revalue the assets and liabilities on retirement? To ascertain the profit or loss and revaluation, and this is transferred to all partners' capital account in the old ratio. Why is retiring partner entitled to share the goodwill of the firm? Because goodwill has been earned by the firm with the efforts of all the existing partners, including the retiring partners. So A, B, and C are partners in a firm sharing profit and loss. The ratio 3:2:1. B retires. What will be the ratio of A and B? That's 3:1 because B is retiring. So when you cancel 2, the remaining is 3 and 1. Journal entry: when retiring partner's whole amount is treated as loan. Retiring partner's capital account debit to retiring partner's loan account. Next, P, Q, and R are partners in a firm sharing profits in the ratio 3:2:1. R retires and the balance in his capital account after making necessary adjustments work out to be rupees 60,000. P and Q agreed to pay him 75,000 in full settlement of his claim. Find out the hidden goodwill. So hidden goodwill is nothing but the amount agreed to pay minus the necessary adjustments. So 75,000 minus 60, that's 15,000. It's from the dissolution chapter. What is dissolution of partnership? This means that partners terminate their connections with the firm and other partners continue the business of the firm in the same firm under the new agreement. Give the meaning of dissolution of partnership firm. It means all the partners of the firm terminate their connections with the firm and business comes to an end. 2 circumstances under which partnership firm is dissolved: consent of all partners, expiry of fixed period, or the death of all partners except one. The difference of dissolution of partnership and partnership firm: business of the firm is not terminated, business of the firm is terminated. Books of accounts are not closed, books of accounts are closed. Realization account: this is actually prepared at the time of dissolution, to ascertain the profits or loss, and you realize your assets and liabilities, and the profit and loss is transferred to the partner's capital account. Why is realization account prepared? To find out profit or loss and realization of assets and liabilities, and to close the accounts of various assets and liabilities. Accounting treatment for unrecorded asset realized on dissolution of firm: cash or bank account data to realization account. Accounting treatment for unrecorded liability paid on dissolution of firm: realization account data to cash or bank account. How do you treat PBD on dissolution of firm? So PBD is provision on bad debts. It is transferred to the credit side of the realization account. So PBD account data to realization account. Journal entry for an asset taken over by a partner: partner's capital account data to realization account. Journal entry for a liability taken over: realization account data to partner's capital account. For transferring an asset to realization account data to asset account. For transfer of an outside liability, liability account debtor to realization account. Payment of partner's loan on dissolution, partner's loan account debtor to cash or bank account. For the sale of an asset, cash or bank account debtor to realization account. For payment of a liability on dissolution of firm, realization account debtor to cash or bank account. For the transfer of profit on realization account debtor to partner's capital account. Journal entry for transfer of loss, partner's capital account debtor to realization account. For realization of expenses paid, realization account debtor to cash account. How do you close realization account? You transfer the profit or the loss to all the partners' capital account. Journal entry for realization expenses paid by the partner on behalf of the firm. Realization account debtor to partners' capital account. So we are done with the 1 markers and the 2 markers. There are some MCQs and the fill-ups. We'll just go through once. All profit sharing ratio is used to distribute accumulated profits and losses at the time of retirement of a partner. Profit or loss on realization on revaluation is shared among the partners in the old ratio. New ratio minus old ratio is gain ratio. Accumulated losses are transferred to the capital accounts of the partners at the time of retirement in their old ratio. General reserve is to be transferred to all partners' capital account at the time of retirement. Goodwill raised to the extent of retiring partner's share only is to be debited to continuing partner's capital account and gain ratio. In the absence of any instruction, retiring partner's capital account is closed by transferring its balance to retiring partner's loan account. New ratio is used for adjustment to continuing partners' capitals. X, Y, and Z are partner share profits and loss in the ratio 3:2:1 by retires. So the ratio of X and Z will be 3:1. Share gain is calculated by deducting old share from the new share. Ratio in which the remaining partners will share future profits after retirement is called new ratio. The balance in the retiring partner's loan account is shown on the liabilities side of the balance sheet till the last installment is paid. The amount to pay to the retiring partner in excess of what is due to him is called hidden goodwill. In the absence of any agreement, the disposal of amount due to retiring partner, Section 37 of the Indian Partnership Act 1932 is applicable. If goodwill already appears in the books, it will be written off by debiting all partners' capital account at their OPSR. So this it's almost the same. There are 3 ratios. One retires, so what will be the new ratio? That is fine. On retirement or death of a partner, the retiring or deceased partner's capital account will be credited with his or her share of goodwill. We'll just do one of this. All profit sharing ratio among Rajendra, Satish and Tejpal was 2:2:1. New profit sharing ratio after Satish's retirement is 3:2. Gaining ratio is 1:1. Okay. Abhishek, Rajat and Vivek are partners sharing profits in the ratio 5:3:2. If Vivek retires, new profit sharing ratio is 5:3. Okay. Next, in the absence of any information regarding acquisition of share in the profit of the retiring or the deceased partner by the remaining partners, it is assumed that they will acquire his or her share in the old profit sharing ratio. Chaman, Raman and Suman are partners sharing profits in the ratio 5:3:2. Raman retires, the new profit sharing ratio is going to be 1:1. The goodwill of the firm is valued at 1 lakh. Raman's share of goodwill will be adjusted by debiting only Suman's capital with rupees 30,000. Okay. True or false? Profit or loss on revaluation is transferred to all partners' capital account in case of retirement of a partner. True. Accumulated profit is transferred to continuing partners' capital account. False. Adjustment of partners' capital of the remaining partners is to be made in the new ratio. True. New share is equal to old share plus share sacrifice. That's false. Share gain is computed by deducting old share from the new share. True. Increase in the value of assets is debited to revaluation account. False. Gain ratio is used to adjust the goodwill raised to the extent of the retiring partner's share only. True. Full value of goodwill raised in retirement is credited to all partners' capital account including retiring partner in the old ratio. True. Section 37 of the Indian Partnership Act 1932 states that the outgoing partner has an option to receive either interest at 6% per annum till the date of payment or such share of profits which has been earned with his money. True. This we will just do the fill-ups and the MCQs. The 1 markers and the 2 markers have already uploaded on my channel. So, Section 4 of the Indian Partnership Act 1932 defines partnership. Partnership has no separate legal entity. In order to form a partnership, there should be at least two people. Partnership is the result of an agreement between two or more persons to do business and share its profit and losses. It is preferred that partners have a written agreement. Each partner carrying on the business is the principal as well as the agent for all the partners. Liability of a partner for his acts is unlimited. In the absence of partnership deed, interest on advance on partner will be charged 6% per annum. Under fixed method, the capital of the partner shall remain fixed. Under fluctuating capital, the partner's capital account balances fluctuating from time to time. Profit and loss appropriation account is merely an extension of the P&L account. P&L appropriation account debit to interest on capital account to interest on capital account. So they give you the narrations in the bracket, okay, because it's clearly given transferring interest on capital to P&L appropriation account. Next, P&L appropriation account debit to salary to partners account, being transfer of partner's salary to P&L appropriation account. When fixed amount is withdrawn at the end of every month, the interest in the total amount for the year ending is calculated for 5.5 months. Under fluctuating capital, the transactions related to partners are directly recorded in the partner's capital account. Under fixed capital method, amount of capital remains fixed. Business of a partnership firm may be carried on by all the partners or any of them acting for all. Agreement between partners must be to share profits and losses. Liability of a partner for acts of the firm is unlimited. The partnership deed should be properly drafted and prepared as per the provisions of the Partnership Act. Clauses of partnership deed can be altered with the consent of all the partners. Next is true or false. Agreement between partners must be in writing. False. The clause of partnership deed can be altered with the consent of all the partners. True. If the partnership deed is silent about the profit sharing ratio and profits and loss of the firm is to be shared equally. True. A partner is entitled to claim interest at the rate of 10% per annum on the amount of capital contributed by him if there is no agreement in the firm. False. In the absence of partnership deed, no partner is entitled to get salary. True. Under fixed capital method, the partner's capital account will always show a credit balance. True. Under fixed capital method, the partner's capital account will always show a debit balance. False. PL appropriation account shows how the profits are appropriated among the partners. True. When fixed amount is withdrawn during the middle of every month, interest on total amount is calculated for 6 months. That's true. If there is loss, no interest on capital is to be paid to partners, even if there is provision to partnership deed. True. Accounting treatment for partnership is similar to that of a sole proprietorship business. True. There are two methods by which capital accounts of partners can be maintained. True. Profit and loss appropriation account is merely an extension of the P&L account of a firm. True. Interest on partners' capital is debited to partners' capital accounts. False. In case of guarantee of profit to a partner, assurance may be given by only one partner. True. So these are the MCQs, the fill-ups, the 1 markers and the 2 markers of the 3 chapters that we did. So if you have any doubts, go down the comment box and I'll be able to reply to all your queries. Thank you.